Good morning, everyone. This is Kevin Robbins, CEO of Mid-Atlantic Employers Association. I want to thank you for joining us for our weekly update on all things around COVID and the new normal and what it means to the people side of our businesses. So today we're going to talk about something that's a newer topic we haven't touched upon, but what are the tax issues for employees coming out of new normal and the kind of switch from in-office to virtual or blended work. And we're very interested to hear how it impacts both the companies and their side of the equation, but also employees, because again, the workplace is very different than it was. And then, as always, we'll finish up with Amy McAndrew doing a COVID-19 legal and compliance update. All right, next slide. As I said, we do these every week. Next week, we are going to be looking at something that's all going to start hitting our thoughts, which is how do we now do our year-end reviews in the virtual world? And really, it's about how to have critical conversations when we're doing this virtually. So we'll have some of our internal experts speaking about that along with the legal updates. There are a couple of more larger events coming up. Just to remind everybody, we have on October 30th a Total Reward Summit, which will be looking at compensation, benefits, work practices, kind of with an eye towards 2021 and the new normal. December 10th, we have our business trends event. We're in the midst of doing our survey now, so if you haven't completed, we will send the link. I think we have about 1,300 businesses nationally participating, so it's a really significant year to find out perceptions and trends towards the economy, business, and people practices, so I hope you can participate. We will release those results on December 10th during an event that will also include economist Joel Naroff and Mike Trackman, who will discuss the kind of post-election impact from a legislative perspective. Next slide. And then tomorrow is a very important event, our Diversity, Equity, Inclusion Conference. I know it's a little bit late, but if you do have time, it's from 9 to 1:15 tomorrow. You can see our list of speakers there. And again, if you can join us, we will send the link out post-event today. So again, this is another topic that's very much in our minds these days. So we're trying as much as we can to provide as much information and value to both members and non-members. This is open to everybody, and that price is for members and non-members. Okay. So at this point, I'm going to turn it over to our experts. We have Brian Kitchen and Tom Frischello from Kreischer Miller, who are going to discuss all the issues around taxes, which again, coming up to year end is, I'm sure, on everyone's mind a little bit. All right, guys, take it away.
All right, I hope I did that right. Tom, can you see it? If you can see it, everyone else can.
I can see it.
Okay.
Yes.
Thank you, Kev. Thank you all for joining today. Kevin was kind enough to ask for us to participate in this week's town hall. We thought it would be helpful to discuss some issues and, more importantly, some questions that we've received a lot of from our clients. Most are going to be payroll tax related on the state, call it state local withholding side. I'll shift more to the federal tax concepts. The largest question we've had over the last month or so is in regards to this, call it employee payroll tax deferral. That's a question that, there's still a lot of uncertainty surrounding that concept and what it means. Is it mandatory? I'll dive into some of the basics as well as some of the questions that we've been getting, as well as how we've been fielding those questions. And then lastly, and this is an important one, and we've had this question come up a number of times, basically since April, and this goes down as it relates to you have employees that are now, obviously working remotely at a larger degree. Some of our clients and are considering reimbursing their employees for additional cost incurred, perhaps giving them an allowance to cover certain costs or to buy printers and so forth. I just want to touch on that topic as it relates to what documentation should be considered, what you can rely on from a federal tax perspective, and then just comment lightly on potential state tax implications. So I'll hand it off to Tom to go over the state employer withholding rules, as well as some remote worker issues as it relates to withholding. And then we'll shift to the federal tax concept I just mentioned.
Thank you, Brian. Good morning, everybody. It's great to be here and talk about this topic. It's actually a topic that is affecting a lot of employers, and we've actually had a lot of conversations around the issue with a number of our clients as well. And so what I really thought would be helpful is to go through the basics, because in everything that I've read, everything that I've seen, conversations that I've had, I'm of the opinion that not a lot has really changed in relationship to employer withholding. And I think that there's been a lot of confusion around what has become the standard for withholding because of early guidance that was issued by some states, especially New Jersey and PA, around the impact of telecommuting workers and remote workers because of COVID, who were previously working at the employer's site. So when we look at employer withholding, you always have at the heart of the matter is the state's jurisdiction to tax individuals that are residing in their state. That's kind of at the end of the day where withholding has its greatest impact, is at the employee level. And the withholding rules are really set up to make sure that the proper states have the proper amount of tax. Residents wind up taking the appropriate credits against their state resident tax, if that's applicable. And we'll get into that a little bit later, because shifts in withholding policies by employers can now be affecting what resident individuals have as a credit available to them to take against their tax. And generally, the rule is, in most states, there are some exceptions to those states, and we'll talk about those states in a little bit in that exception. Most states go by the performance location. So most states are looking to source compensation by identifying where the services are being performed. And that's certainly the case in New Jersey. It's not the case in Pennsylvania, which we'll get into as we get into our slides. And that's what creates the tension. Fortunately, it's not an issue between these two states because of the fact that we have reciprocity, right? So whenever we get into multiple locations for an employer, which we're essentially dealing with right now with employer offices that may be located in Pennsylvania, but we now have employees who are telecommuting from their home in Delaware, right? Now that employer could have multiple locations and may be wondering, do I need to worry about employer withholding in the state of Delaware? What do I do? And what has happened for a lot of employers is that they've tried to get their hands around, what should my withholding responsibility look like? It must have changed because my employer's not in the office anymore. And that may or may not be a good reason to change your withholding or to have changed. And if you did nothing, you may not have an issue. And as I said earlier, when you've got someone who lives in one state and predominantly works in another state, that compensation that's subject to tax in the work state is usually available to offset the employee's resident tax through the mechanism of a credit. Brian, if we can go to the next slide. As we said, however, you start getting into variables that will affect your withholding rules. And one of those variables is reciprocal, or are reciprocal agreements between two states. Pennsylvania and New Jersey have reciprocal agreements. So a lot of our participants on this call may have a large part of their concern taken off the table because of reciprocity. Because if you're a Pennsylvania employer and you have New Jersey resident employees that are now working from their home in New Jersey, nothing really changes for those employers, and vice versa. New Jersey employers who now have Pennsylvania employees working from home, nothing's changing. Your withholding hasn't changed. The one variable that you could get into with regard to Philadelphia-based employees with New Jersey resident employees is the Philadelphia city wage tax. And we'll get into that a little bit later, because that a lot of New Jersey residents did not have any New Jersey withholding because the city wage tax was sufficient to offset their New Jersey taxes. Now we may have a scenario where, as a Philadelphia employer, those employers may not have continued withholding the Philadelphia city wage tax, and maybe they didn't turn the New Jersey withholding engine on. Maybe the employees didn't know enough to tell the employer to turn the New Jersey withholding engine on. So there could be some gap between the withholding for that employee where it could result in a New Jersey tax liability. And then always realize that, this sudden shift in withholding could result in a need for employers to obtain updated withholding certificates. So as we said earlier, remote workers generally owe taxes to the state in which they are performing the services, regardless of the employer's location. This is where we get into that exception, and that exception is referred to as convenience to the employer. So in our mid-Atlantic area, the states that use convenience of the employer rule to source wages are New York, PA, and Delaware. And New Jersey uses the work location to source. Now, PA and New Jersey are fortunate because reciprocity takes that tension off the table when you're talking about a remote worker who worked in Pennsylvania but now works in their home state. The rule for Maryland as well is also a work from state for purposes of sourcing compensation, and that's where there could be a little bit of tension, right? Because now you've got remote workers, and you've got the Pennsylvania rule, which is convenience to the employer, and you've got the Maryland rule, which is work from location. Now, what I would say is that early on during the government ordered shutdown, a lot of states came out and with guidance around telecommuting employees, but that guidance was really around what does it mean for the corporate entity and their filing responsibilities and nexus for those corporate entities. And the states were very clear about withholding. And the states have said, look, nothing really changes for us. New Jersey says we're going to still look at the employer jurisdiction to make the determination as to whether or not it is New Jersey's source compensation or the other state's source compensation. Pennsylvania has said we're still going to look at convenience of the employer. We're not changing anything. So even if you've got a remote employee, but your employer location is Pennsylvania, we're going to look at that and continue to determine that is a Pennsylvania source income and subject to withholding in the state of Pennsylvania. and that's where I think a lot of the confusion is coming in. I'm not aware that Delaware has issued any guidance around that. So Delaware, as I said, was a convenience to the employer. So I would think that nothing really changes for Delaware employees now working from their home and in Pennsylvania, or Delaware employees working from their home in New Jersey. So, and vice versa for the other states. But what I would say is this is where the issue around Philadelphia comes in. And Philadelphia came out and was very clear in the guidance that they issued. And they said that they're not changing their withholding rules, but they are saying that employees who were ordered to work from home during the government shutdown and are non-residents of the city are not subject to the tax in the city. That, to me, is where the real rub is. Philadelphia also uses convenience to the employer rule to source wages and to determine whether or not those wages are subject to the city wage tax. And so now those workers that are no longer in the city of Philadelphia and subject to the city of Philadelphia city wage tax, what do they do? Because they may, if they live in Pennsylvania, they may live in a jurisdiction that imposes a local earned income tax. And in the past, they've always relied on the city wage tax to determine whether or not they are owing their own local tax. And that's never going to be the case, because Philadelphia has always resulted in a non-resident tax in excess of the tax that they would owe in their resident local jurisdiction in Pennsylvania. Now that may not be the case. Now they may be in a scenario where they could owe some, maybe a lot, of local tax, depending on what the employer has done for them. And that also becomes a question in terms of compliance. And what we found is that some employers have responded to these shifts in withholding very differently. We've got clients that have done nothing for purposes of withholding. We've got clients that have reassigned employees that are no longer in Philadelphia, but working from another location to that other location to excuse the Philadelphia wage tax, but subject them to a different local tax. And I think every employer's situation is going to be different. And I think going forward, as employers begin to roll out of the office closure phase and start to reopen, I think they're going to start having to address issues of withholding, especially in the city of Philadelphia, for those employers that are in the city of Philadelphia. And this slide really gets to the point of saying an employer really isn't subject to employer withholding until it becomes an employer in that state, right? So a lot of the guidance that came out early on around telecommuting employees and employers or businesses having nexus, like PA and like New Jersey, they've come out and they've issued that guidance, but and they say that remote employees don't, as long as they're temporary. Now you get into the question of, if they're not temporary, if I never reopen my office, are they temporary? Well, they're not. Now they're not there because of COVID and the government shutdown. They're there because I've made them permanently there. And so that does create nexus for employers. And I think employers need to be aware of that. Because all of a sudden now the employer has nexus. Now they've got an employee that's working from that state location. Now they may have a change in facts and circumstances around that employee, around whether it be convenience to the employer or work location, because that is the state sourcing rule. And that's where they need to address their their withholding rules. And I think they also need to address those withholding rules as they, if you have, for businesses that were predominantly located in Philadelphia that have all of a sudden said, we're never returning to our office. What does that mean for those employees when it comes to Pennsylvania local taxes? A lot of those businesses have not had to worry about Pennsylvania Act 32 types of issues because they were in Philadelphia, they withheld and remitted to Philadelphia, and that was it. And I think we could have a whole session on Act 32 independently of this session because of what it requires, right? It now requires you to withhold tax in the hire of the work location or the resident. Well, now, if you've made your employees' residence that their permanent location, essentially, you should be withholding the local earned income tax in that jurisdiction. And now all of a sudden you go from one reporting jurisdiction, Philadelphia, to potentially many. And that's where we talk about updating the withholding certificates. And so, you know, some things to really start considering as employers is, or are Act 32 withholding. Do my withholding responsibilities change once my office reopens? And that really gets to, did your withholding policies change during this? Or did you as a business decide administratively, we're going to continue to withhold as we always have in the past? And if that becomes if my facts and circumstances become different, well, then maybe I need to revisit permanent versus temporary remote workers and what that impact is going to mean for me as a business and my withholding responsibilities. And then the last one is really, as an employer, do I have a responsibility to inform workers of their potential tax obligations due to my changes in withholding? And I think that there's always some degree of responsibility in relationship to making your employees aware of the fact that your withholding, as it has been in the past, may not be the same this year. And at least you should be talking to somebody about what that might mean for you, because maybe now you will owe tax in your home state because we haven't withheld tax in Philadelphia, or we haven't withheld tax in Delaware. And so a lot of employers may need to revisit what their withholding policies mean to their employees, and at least put some kind of communication out there and make people aware that maybe you want to talk to somebody to see if this is going to change what you've historically done in your personal return.
Thanks, Tom. So we'll take a brief spin through two federal tax concepts, one of which is, you know, likely or has garnered some questions, and then we'll run through any questions anyone may have. And separately, both Tom and myself are available via email if you have any direct questions. So the first program I want to touch on for a minute is the payroll tax deferral program. And I want to distinguish this program from call it the employer deferral program, of which a lot of our clients had taken advantage of as a result of the CARES Act back in March. This is different. This is the employee share, of which would normally be withheld from the employee's pay and then remitted via the weekly payroll, or however frequent the payroll is. So this was President Trump's executive order that was ruled on early August. IRS came out with guidance late August, of which the deferral was supposed to be available from September 1st through the end of this year. A couple of other items to note: wages have to be within a certain range, below $4,000 on a biweekly basis. And two really important concepts here is that as it stands today, the deferred taxes would be withheld, but then they would be repaid ratably over the first quarter of 2021. with the full amount being due by May 1st of 2021. And if it's not remitted, then the employer would be responsible for paying any penalty and interest. So the common questions that we're getting is this mandatory? What happens if an employee had payroll taxes deferred and leaves the company? Am I required if the employer requests it? It is very emphatic within the Internal Revenue Code that this is not mandatory, that the employer does not have a requirement to not remit payroll taxes. So under 7508 Cap A, that allows the employer to withhold and remit the taxes on a timely basis. So the question becomes then, okay, what if I do take advantage of this? What happens if an employee leaves? So in theory, you wouldn't have withheld taxes, but you being the employer would have had a responsibility to withhold, but you've deferred it. So that would make the employer responsible for making an arrangement with that employee. If that's impossible because of logistics or you weren't thinking about it, then the employer would be responsible for remitting that deferred tax by that May 1st deadline. And then one of the more common questions is if an employee requests it, is the employer required to oblige? And the guidance is assertive here, and it says that the effective taxpayer is the employer and not the employee. So just segueing into some significant considerations, this is really an opportunity to educate your employees on what this deferral actually is. And what it actually is today is a loan. So to the extent that you've taken advantage of this deferral program and the employees now have this excess cash flow, that's not really excess cash flow, to go buy a PlayStation, but more importantly should be reserved, as it will have to be repaid in the coming quarter, the first quarter of 2021. Now, the other question we're getting a lot of is FOMO, or fear of missing out, if Congress does actually forgive this loan deferral. And this is pure speculation here, but I've attended a lot of webinars, and the feedback we've garnered that we do believe that there will be a vehicle on the W-2 this year that will allow the W-2 to communicate with the Form 1040 to the extent that this is forgiven, that there'll be some sort of formula that'll give those employees who didn't take advantage of this and were eligible the opportunity to take a tax credit on their Form 1040. And again, this isn't set in stone. This is a purely speculation, but that would be the only opportunity for Congress to actually level the playing field for those employees who were taking advantage of the deferral, subsequent to that taking advantage of the deferral, had it forgiven, versus those employees who didn't or who wouldn't provide the opportunity to take advantage of that payroll tax deferral program. Now, quickly here, this shouldn't, this is very common actually, given the new norm. The questions we get, I want to reimburse some employees for, personal expenses as a result of working from home. And then, at least in this environment, it is for the convenience of the employer. So the standard rule, if this wasn't COVID time, and you're trying to, just be a good employer and give your employees flexibility, you would have to ensure that you're accounting for those reimbursements on a, call it, receipt basis, meaning that if you are going to reimburse for personal expenses, there would have to be of a business nature. The employee would be responsible for submitting documentation for those reimbursed expenses. And to the extent that those steps were satisfied, that reimbursement would not be taxable to the employee. It would be an ordinary and necessary business expense for the employer, and the employee, it would be a, call it, working condition fringe benefit. The times have shifted, though, now that COVID has, somewhat made that much more of a common situation. So the questions we get, as I had mentioned before, I want to reimburse for utilities, internet, I want them to get a new printer, or I want another screen, what are my options? And then another question that I haven't gotten a lot of, but I had gotten a couple, am I required to? Some states actually have a requirement by law to reimburse for certain additional costs incurred. Good news, at least on the federal tax side, is that COVID is a federally declared disaster, meaning that the flexibility for reimbursement is available under Internal Revenue Code Section 139, tax-free reimbursements for related work from home expenses would come under that umbrella. And the key component here is that that substantiation requirement that I had mentioned previously under a more formal accountable plan is not required as long as the expenses being reimbursed are reasonable. And again, we're using very generic terms here, but you would just have to use good faith and judgment when you are reimbursing. And for those employers who haven't thought about reimbursing, because we thought maybe this wasn't going to be a 6-month ordeal, knowing that we're getting into the year end and you're thinking about some fringe benefits to offer your employees given the pandemic, this is an opportunity to at least think about what's transpired over the last 6 months. And to the extent that this was on the table and you hadn't taken advantage of it, now is an opportunity to at least visit it. Are reimbursements mandatory? As I had mentioned, teleworking employees could be eligible for mandatory benefits. Our surrounding states, most of which you folks would have a presence in, or at least employees residing in, do not have a requirement, but a state like California does have a requirement. The other question we have are disaster relief payments taxable. So under 139, I had explained that if you want to reimburse for work from home expenses under 139, it's federally tax-free. The states may have a different perspective on that. The good news is that our surrounding states, Pennsylvania, Jersey, New York, Delaware, they do follow the federal tax concept of Section 139, which does allow for exclusion from the employee's income. One major comment here, 139 only applies to the extent that this COVID-19 is a federally declared disaster. So if we go into an environment where the new norm becomes more of a new norm and becomes more of a permanent norm, even though we're not in the COVID landscape, and you want to continue with this fringe benefit, you would have to be mindful that you have to revert back to that standard accountable plan rule. Meaning that if you wanted to continue with this, call it reimbursement of expenses or providing an allowance, if you will, that would require the employer to change the documentation requirements and start requesting substantiation from the employees receiving the fringe benefits. And I had mentioned before, Tom's information is here. We did run through this really, really fast, in my opinion. So if you have questions that we can't answer during Kevin's Q&A, we're certainly happy to answer any questions you may have outside of what we can fit in this time lot.
That's great. Thank you, Tom and Brian. We did have one question. Someone asked whether it'd be possible to put together a list of states that do have a reimbursement requirement. If you could do that, we can forward it out to the participants. And then one real quick question for you, Brian. If a company is not reimbursing, what are the basic guidelines for someone to take home office expense deductions for some of those things you discussed now that, again, people are working from home more regularly? Do
you want to hear the bad news or the good news?
Bad news. Yeah.
Well, as with many changes in the tax code under President Trump, the Tax Cuts and Jobs Act actually eliminated the ability to deduct home office expenses. So that would have previously been an allowable itemized deduction on an individual's personal tax return. That deduction has since been eliminated, at least temporarily. It does revert back, I believe, in 2026. I hope to God we're not going through this for another 6 years. The good news is Pennsylvania does allow for a deduction for unreimbursed employee business expenses. The document, Tom may have a comment on this, but Pennsylvania, depending on how aggressive you are on those expenses, Pennsylvania does have a common theme in requesting for support for those expenses.
Okay.
That's
great.
True.
And I think someone asked a question. I think you covered Maryland, but back to Tom, what you were discussing, do DC or Virginia have any special rules that would be different than what we discussed?
No. So DC, so neither DC nor Virginia have issued any guidance specifically around the remote workers. Both jurisdictions utilize the work location to source income. The good news about, I don't remember off the top of my head about DC, but I can get that back to you, Brian. But the good news about Virginia, at least, and Maryland as well, is that both states are states with reciprocity. So at the end of the day, if you had employees that were working remotely from those jurisdictions, from say a former work location in Pennsylvania, they should have already been covered in relationship to any changes that were there. Employers should have been withholding the state income tax because of reciprocity in those states. So hopefully any changes would be minimal to employers in those jurisdictions.
Great. All right. Well, thank you again. That was very informative and very dynamic space right now with taxes and COVID. So I appreciate Brian and Tommy joining us. With that, we'll turn it over to Amy for the legal update.
Thank you, Kevin.
Thanks,
Great.
Kevin. Bye-bye.
Thanks, Kevin. And thank you, Brian and Tom. That was great,
Okay.
very informative. We do get those questions a lot, so that's good to know.